Thank you so much. Yes, I am joined by the chairman of the Federal Deposit Insurance Corporation, Sheila Bair. And I know how busy you are right now, and I so appreciate you taking the time for us. But first of all, Sheila, what's at stake here?
Well, I think actually I'm starting to get more optimism here. I think we are seeing some signs of thawing, some signs of improvement. Many banks are making money. I think there's a very good reception to by the market yesterday of the asset purchase program, which is a validation. This is certainly something that we've been pushing for some time. So I think a lot still continues to be at stake. We have a recessionary environment. We want to make sure that doesn't get too much worse, and we need to make sure we have a functioning banking system to make sure it doesn't get too much worse. So I think the steps that have been taken, I know there are a lot of programs out there and there's confusion, and that's one of the reasons I want to be here with you today, to provide clarity where I can. But overall, I think the measures are starting to work, and I think we all need to take heart that we will be digging out of this.
And certainly, you know, everyone's rooting for the regulators, for the policymakers in Washington to get this right. But one of the questions, even the investors who are interested in participating seem to have, is the banks, because the banks have said we don't want to pay the fire sale prices. Investors don't want to pay above what they would consider fair value. So are you counting on this whole, you know, providing the leverage, providing the financing to make up the difference?
Yes, we think one of the, and we have a lot of experience selling troubled bank assets, obviously, in our role as receiver, and we're finding that what's really weighing down asset prices right now is what we call the liquidity discount. So because credit markets are still not functioning as well as they should, it's hard to get financing to buy assets, and then it's an illiquid market, so once you have them, you can't, you know, you're pretty much stuck with them. So we think by teasing out that liquidity premium, we will get the prices up to what would more be traditionally be viewed as a fair market value. There will still be some discount to book value, obviously. There will be embedded credit losses. There will need to be some risk premium given what is going on in the economy right now. But we think we will be able to get the prices up to that magic point where seller and buyer are willing to meet.
Now, you've said recently that you've been inside the bank, so you know that a lot of these securities are worth more than the current assessment the market puts on them. Why do you say that? I talked to Paul Krugman earlier today. His view, he's not a bank regulator, but as an economist, he says no, he thinks some of the banks just made bad bets, and these securities are beaten up and will forever be beaten up.
Well, let me first say, our piece of this program is to buy the whole loans. Treasury is running a separate facility for buying the securities, so we will not be involved in that piece. We'll be buying the whole loans. And I think perhaps a more traditional analysis of credit quality and credit risk with the whole loans is possible. It will be time consuming, but it is possible. The securities, you know, there's a lot of different structures out there. A lot of the CDOs have very low value. Others have higher value than what the underlying cash flows would suggest. So I think it's hard to make categorical statements that all these securities are marked too low, marked too high. I think it needs to be determined on a more of an individualized basis. But I think overall banks have been pretty aggressive, and their securities are held at fair value now. And I think banks have been pretty aggressive at marking them down. So I don't think it would be right to make a categorical statement that they're all overvalued. I don't think that's right now.